I've been trading for over 5 years, and honestly, I wasn't profitable for a long time. But that finally changed when I found this one stupidly simple strategy, which has now made me over $400,000 in the past year. It's beginner friendly, and most importantly, it works. And in this video, I'm going to break it down step by step and then do a 1 month back test just to prove to you that it works. And if you look here, you can see I received a $56,000 payout from Top Step, and that was back to back. I made over 113K in 3 weeks trading this strategy. And before we dive into the strategy, I'm going to show you my journal log for the past month of September. You can see I've traded 8 days and made over $13,000 just simply trading this strategy. And now that I've kind of shown you this journal, we're going to dive into the basics. So this strategy is built around liquidity sweeps. It's basically a fake in one direction and to grab orders before reversing. So it's pretty simple when you think about it in the idea that it traps traders. It's trapping people above a certain area and then starting to move in the opposite direction. So here we have a high and a low. The market will then trade up into a high, making traders think that a breakout is occurring. Then the market, what you want to see for this strategy is the market sharply move in the opposite direction. And for our confirmation, we have our fair value gap. We wait for that candle close, and we have a nice set of clean set of lows down here. So we wait for the market to trade up into a high or a low. And then once we get that sharp rejection, we can then start targeting opposing sell side liquidity. And that's really the most important part when trying to catch those reversals. We don't just jump in on every sweep. We wait for that confirmation. We wait to see price get displacement away from that area. And what I mean by displacement is we see candles start to move aggressively away from that liquidity area. We don't just fade the market on every sweep. We wait for that confirmation. That confirmation protects us from essentially gambling instead of guessing. You're more so reacting to what the market is showing its hand. You're letting the market tell you. Really, to how to avoid those fake outs is like the market might seem like it's sweeping one side. Like here we have our highs and lows, and the market comes up above the high, and what looks like, it might play around and it keeps going. This is where people blow their accounts, is because we swept out liquidity and they start thinking that, oh, we took out liquidity, it's going to reverse. Without that confirmations or no displacement to the downside, no aggressive push, this is invalid. That's not what you want to see. This is how you can avoid the fake outs. So we have our highs and lows. The market might look like it's sweeping the highs and then it keeps running. Like this is where people blow the accounts because they see it taking the highs and they're like, oh, we took out liquidity. Let's hit that sell button. Let's target the downside now. Without displacement moving in the opposite direction fast, you're essentially not trading the strategy right. You want to see price sweep liquidity and then move in the opposite direction. Without that displacement or candle confirmation, without our inverted fair value gap candle close, this is not valid. You can't just come into the market and trading every sweep. If you are unsure if this is a valid setup, it's better to just pass on it and miss the trade and then just watch it. Just watch what the market is doing, and that will help build that confidence to then, knowing how to react the next time you see that occur. Once you have waited for the sweep, you've targeted opposing liquidity. When you're placing that trade, let's say for this example, we've taken out buy side liquidity. We are then looking for sell side liquidity. We'll put our orders in right here and we'll put our stops at this most recent swing high. And we're targeting down here towards this sell side liquidity. This is where we're taking profit at. And don't worry if this feels like a lot. I'm about to show you some real chart examples step by step, so you'll really see how exactly that this works. I just want to show you the big picture of identifying liquidity, waiting for that confirmation, and then managing your risk. Now that I've shown you the basics of my strategy, let's hop into some chart examples to really show how you can play this strategy. So when coming into the session, this is the easiest way to spot these trades, and that is by marking out the previous daily high and the previous daily low of the candle, because this is the most obvious points of liquidity, using these previous daily low and previous daily high. If price typically will come down and either continue under or above one of these areas, or it will take one side of these and then continue in the opposite direction. So if we drop down to a lower time frame and wait for the market to take one side. So now that the market has taken one side of liquidity, we can then drop down to a lower time frame. This even works all the way down to the 1 minute. On this time frame, I take my trades on the 1 or the 5 or the 15. It just depends on what the market is showing me. And so if you look right here, we taken out that sell side liquidity. We took out previous daily low. And look at what the market did after taking that liquidity. We started creating bullish fair value gaps. Price is starting to move in the opposing direction. And so this is your entry trigger. Once we get that candle close, this wasn't the best look at displacement to the upside, but you have to trust your model. And so you would simply put your buy order in on that inversion, stops at the swing low, and targeting buy side liquidity. There's levels of liquidity at each one of these highs. These are areas where you can take profit, put your stops to entry, just areas where you can start to manage your trade. And as the price, as you see price start moving up into these areas, this is where you can simply just drag your take profit up and watch how the market is reacting. So now that we've taken out some of these liquidity, notice how we're creating more bullish fair value gaps. We are seeing price continue to move up towards that previous daily high. So simple enough, like this is the reaction that you want to see. You want to see us take out liquidity and start to move aggressively in the opposite direction. You want to see us start creating bullish fair value gaps. We don't want to see price create this and then simply give it back right away. We didn't want to see price chill out down here. We wanted to see price move aggressively after taking out some sort of liquidity. So let me show you another example. Without using previous daily high, we can also use Asian session and London session. This is the session where Asia traders are typically trading, and this is the session where London traders are typically trading. And so what we get is that normally we get an Asia accumulation and a London manipulation. And what we get is when London manipulates one side of Asia range, we expect New York to come take out at least the other side or potentially towards another point of liquidity. So for this example, without using that previous daily high or previous daily low, we are not using price, but we are using time. Time is just as important as price. And I have these graphics here just to make it easier for the eyes, but we have our Asian range and London manipulated one side. And what did price do when it took out these Asia session lows? Immediately getting bought up. This was some news reaction right here. So even with news, this model is still valid. And just being on the 5 minute, you can notice the reaction we got. We came down and swept out that liquidity and immediately got a bullish reaction. And here we get a 5 minute inverted fair value gap. This would be your entry. And given where the stops are, you could either put them at the swing low or to manage risk, have it a little tighter, but you're targeting this next set of highs. When you have to have such wide stops before confirmation, this is where I recommend going in with a little bit of a lighter size. Once you have that confirmation with the candle close, I mean, we can just see it come to this first set of sell side or buy side liquidity. This is where you'll secure some profits or trim, put your stops to break even if you don't want to see it come back down. This one ends up coming back down, but it retests that area and continues with trend. So a lot of people do tend to wait for that retest. I'm typically one that is aggressive with my trading, and I'll take my profits at first sets of buy side liquidity, or just aggressively watching price as the candles print. And because I'm not scared to fire again if I have to, but I hope that kind of clears up some of the smoke. But simply enough, it is just a sweep of liquidity, invert the fair value gap, and target opposing sides of liquidity. Like I was saying previously, if the market is bullish, we are waiting for sweeps of sell side and then expecting the market to reverse in the opposite direction and continuing with that bullish trend. So now that I was able to show you a few examples of how I spot and find some of my trades, let's dive into some of the backtesting results that I did for the last month of August. So we had a total of 20 trades taken, one for every day of the trading week, and we had about a 55% win rate throughout the whole month. And you can see here, we had 11 wins and 9 losses. We had a consecutive of 3 wins, 3 losses, and each loss that we took, we were risking about $500. Our total winnings was $6,279, and our total losses $4,301, for a net profit of $1,977. So for the whole month, just by trading this strategy, ultimately it's profitable. My average win was $570 and my average loss was $477, for an average risk to reward of 1-to-1. So even though I was taking some losses during the month, ultimately I still ended up profitable. You don't need to have to win every trade in order to be profitable. The most important part is having that positive R collection. So I could take 2 losses and 1 win make up for those 2 losses. And with this strategy, I believe it is very simple and effective, especially when you're implementing it in the right areas. And you can see here, Mondays, it had about a 50% win rate. Tuesday, 75% win rate. Wednesday, Thursday, Friday, 40, 40, and 75. It was most profitable at the beginning of the week of August. There wasn't much news given this August, so when we are trading, it helps to have volatility in the market. And if we don't have that news, it basically brings less probability into the markets. And if you look at this chart too, starting with 0 trades, and as we make our way up, the number of trades we have a curve here. We have a profit curve. So as we kept taking our trades, we kept playing our model. Yes, we were taking losses, but our wins were outweighing them. So that's pretty much it. This is my backtested results for the month of August. You know, taking at least 1 trade a day and waiting for my setup patiently. Yes, it didn't hit every day, but I was still able to turn a profit. Those backtesting results, they might be strong, but none of it matters if we're not following our rules. And so these are the important rules that I stand by when I'm trading with this model. And number 1 being no raid, no trade. If liquidity hasn't been taken, I'm not interested. Patience pays more than forcing entries. Like that's the most important one. If we don't have any liquidity taken, we are just in the middle of price, and I am not interested in any of it. My next rule is 1 and done. I stick to my plan. I take 1 clean setup, and if it's not there, I walk away. Over trading will kill your accounts faster than the good losses. It's okay to take good losses. If you followed your plan and did exactly as you were supposed to, your model presented itself, and you put risk on, that is okay if you lose that trade. You followed your system. There's nothing to complain about that. As long as you're following your system, it's a win in my book. Losses are a part of the game. Next is risk first, profit second. When you're calculating your trade, you should always know how much you're willing to lose on that trade. It's the only thing you can control in this market, is how much you're willing to lose. And then after that, once you know how much you're willing to lose on that given idea, then you can start to look at how much you're going to make on that trade. A lot of people, what they do is they start to drag their TPs to unrealistic measures. It's not like the market is moving more than 300 to 400 points in a given day. So having logical take profits and having a good balance to your risk can greatly affect your trading in a positive way. So there you have it, the strategy, the proof, and the rules. And if this helped you, make sure to subscribe so you don't miss out on the next one. Thank you.